Hi, I'm Max Keiser, and this is the Keiser Report. You can sum up the entire global situation in 3 headlines. 1, you've got Walmart of weed. Yes, the Walmart of weed is looking to go public in America. Number 2, you've got another headline here that 35 states are now reporting decreases in payroll. And number 3, consumer confidence is up in America. You see, the payrolls are down, but you give enough people enough dope, they'll eat enough munchies like potato chips and Twizzlers to boost GDP. It all makes perfect economic sense. I've calculated that you need to eat approximately 37 quadrillion Twizzlers each out of the next 12 months to balance the budget. Let's go to Stacy Herbert. Stacy.
Hi, Max. I like the way you put this on our website, maxkeiser.com. You said what Keynes called animal spirits has been replaced by the munchies. But, you know, it's not just potato chips and Twizzlers. There's also bath salts. Headline reads, bath salts, a growing drug problem, officials say. So police say they are seeing a growing number of Americans suffering hallucinations, paranoid thoughts, and heart palpitations after snorting, smoking, or injecting chemicals sold as bath salts under names like Ivory Wave, Bliss, White Lightning, and Hurricane Charlie.
Right, so methamphetamine is just not doing it for them. I got an idea. Go into your parents' kitchen, the place where you prepare food. It's different than a McDonald's. And find the largest frying pan you can. Pick it up in both hands and slap yourself in the head with it really hard. That'll give you the same effect.
You might need some bath salts, actually, for the next headline. Emails show Bear Stearns cheated clients out of billions. So, former Bear Stearns mortgage executives who now run mortgage divisions of Goldman Sachs, Bank of America, and Ally Financial have been accused of cheating and defrauding investors through the mortgage securities they created and sold while they were working at Bear Stearns. According to emails and internal audits, JP Morgan had known about this fraud since the spring of 2008, but hid it from the public through legal maneuvers. But last week, a lawsuit filed in 2008 by mortgage insurer Ambac Assurance Corporation against Bear Stearns and JP Morgan was unsealed. The lawsuits supporting emails going back to as far as 2005 highlight Bear traders telling their superiors that they were selling investors like Ambac a, quote, sack of.
Well, yeah, that's right after they tried smoking it. Then they just sold it.
Apparently, they knew that all of the mortgages in these mortgage-backed securities were fraudulent, bogus, likely to default.
Yes.
So they knew they were a sack of excrement, as they call it. After funneling these misrepresented loans with Ambac's insurance, they then, according to the lawsuit, implemented a trading strategy to profit from Ambac's potential demise by shorting banks with large exposure to Ambac-insured securities. And again, these are in email correspondence that they were shorting these banks just after they sold it.
So it's like they get their employees to take out life insurance and then they kill them. Or they take out fire insurance on your house, then they burn it down. They take out insurance against the mis-selling of these securities, and then they make huge bets against it. This is the problem. This is why the American economy is being destroyed, is because the banks are what I call suicide bankers. They're pathologically ill. They're Lloyd Blankfein, Jamie Dimon, these guys. They are sick. They are kleptocrats. They're murderers. They're financial assassins. And this is a typical story exactly as we described it here. They game the system. They game the legal system. And everyone is in on it. The rating agencies knew about this. Fitch and Moody's, they knew about it. They committed fraud. The investment banks knew about it. They committed fraud. The Justice Department and under Bush and under Obama, they know about it. They're committing fraud on a daily basis.
Regarding this story here, recall that it's very similar to the Goldman Sachs AIG deal. And we saw this and we covered this here on the Keiser Report a few months ago, where Senator Carl Levin was questioning Goldman Sachs, including Lloyd Blankfein, and he was asking about emails in which they also used this same word of this excrement, this foul word, this 4-letter word for their deals that they were knowingly selling to their clients. Did anything ever come of that? Were they ever prosecuted? Were they ever charged with fraud? No, it was all just like their sort of language. But I thought perhaps because there is so much of this being sold and packaged by banks, perhaps we could reclassify this as manufacturing. And they could be the world's largest dealer of fertilizer, for example, around the world.
Mm-hmm. Fecal securities, fecal-backed securities. Well, basically, when you put, let's say, Jamie Dimon, J.P. Morgan, and Lloyd Blankfein of Goldman Sachs into a room, they crap in each other in their underwear. Then they rip that out, and then they sell to each other for a fee. And then when it turns out that what they sold, which was the basis for the entire collateral of the American economy, turns out to be nothing but the fecal matter of Jamie Dimon and Lloyd Blankfein, and their banks are threatened with insolvency, they then get Hank Paulson, who was at Goldman Sachs, then was working at the Treasury, to go down in front of Congress, put a gun in front of their head and said, either give us $750 billion, or we're going to blow up your economy. We're going to threaten martial law. So they've got the goons, they've got the fecal matter security sellers, they've got the compromised legal precedents. There's no rule of law. It's a kleptocracy. And they sell poo-poo with each other, and they call that, and that's the economy. American economy is based on selling poo-poo from one bank to another for fees, and then when it's too much poo-poo in the system, they declare bankruptcy and they mandate a bailout, which of then it's like getting a clean underwear. What are they doing to clean underwear? Oh, that's more American securities. There's more America. There's more American securities. Let's sell them. Let's get another $1 billion bonus. Oh, I just made myself another bonus. That's what Wall Street's all about. It's just selling poo-poo. That's it. It's worth nothing.
Also, according to the article from Terry Buell, a public hearing is currently scheduled to be held by the New York State Assembly regarding whether legal action should be brought against banks for misleading insurers about mortgage-related securities.
Gee, I wonder. Well, Americans live in the sewer. I mean, that's financed by these banks that point to this sewer and sewage and say, that's a AAA-rated government-secured bond. You should be happy you're living in that AAA-rated government-secured sewer bond.
Well, they're all at this Walmart of weed, smoking dope, or breathing or inhaling or injecting bath salt. So, they don't know what it is that's going on Wall Street.
So Bernanke's clearly addicted to crack.
So, is it going to get better? Mortgage lenders seeking court permission to destroy 22,100 boxes of original loan documents. So this is what they've taken from this, because there's been no justice. All they're doing is let's get rid of any evidence that remains, and so that no lawsuit could ever be brought against us, because the original documents will no longer exist.
Oops. Well, they should sell them to the company that wants to be the Walmart of weed, and they can sell them as rolling paper. So you go in there to the Walmart of weed, you buy a pound of cents a million, and you get some of these original issue mortgage documents to go with it to roll up your dope with, and you can be just like Ben Bernanke.
Actually, you gave me another idea, because maybe all of these collateralized debt obligations that Bear Stearns was selling, and now J.P. Morgan owns them, maybe they could sell them to the likes of Monsanto as a new sort of fertilizer, like chop up the paper and dump it in the, agricultural.
Well, it can definitely go in. According to Taco Bell, there's a lawsuit against Taco Bell that the beef in their beef products is not actually beef. So I'm sure chopped up mortgage paper would substitute. Well, it's like that story we did last year about the Chinese bun manufacturer that sold soot-enhanced cardboard and called it a enhanced cardboard soot bun.
So let's move on to the next headline, also related to all of this. Mortgage giants leave legal bills to the taxpayers. So even if Bear Stearns or J.P. Morgan have to go to court to defend this, it looks like, the taxpayers are being stiffed with all the bills. Since the government took over Fannie Mae and Freddie Mac, taxpayers have spent more than $160 million defending the mortgage finance companies and their former top executives in civil lawsuits accusing them of fraud. The cost was a closely guarded secret until last week, of course.
The guy who was keeping the secret was high on dope, and he let it go to WikiLeaks.
Yes, this is in order to defend Fannie Mae and Freddie Mac executives like Franklin Raines and Timothy Howard. And of course, Fannie Mae and Freddie Mac bought a lot of these bad mortgages from these banks as well.
That's part of a huge scam, because they got a government-sponsored entity, allows them to play and game the interest rate spread between government securities and non-government securities. Here's my prediction. I made it last year. I'm sticking by it, that before the end of this year, Fannie Mae and Freddie Mac, a $5 trillion liability on America's balance sheet, will be bought by the Chinese. And the biggest landlord in America will be China.
Well, they could end up being a good short to short China, because if Bear Stearns is correct about their assessment of what is in these mortgage-backed securities.
Well, there's a huge short bet on China now with Jim Chanos, I think. The guy shorted Enron. He's short China, so that could be the basis of it.
And so is it going to get better or worse? Well, look at this chart of the day. The housing double dip is accelerating. Home prices dive 1.6% in November. So the trend is continuing down. It appears that Bear Stearns was indeed correct, Max, that what they sold and what is backing these mortgage-backed securities, which is now owned by the taxpayer via a new accounting law introduced January 6th by the Federal Reserve Bank, is that, remember, they can no longer go insolvent because they could just transfer their bad liabilities to the Treasury. So they're just negative liabilities owned by the taxpayer.
That's right. The Fed's balance sheet can expand exponentially ad infinitum to accommodate an infinite number of bad loans as the real estate market gets into a double crash, which means banks go into another crash, which means another big bailout from Congress at gunpoint or threatened martial law. And it's all quite nightmarish for the U.S. dollar, isn't it? All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more coming your way, so stay right there. Welcome back to the Keiser Report. Time now to go to Los Angeles to talk to Nomi Prinz, author of It Takes a Pillage, an epic tale of power, deceit, and untold trillions, now available in paperback. Nomi is a former managing director at Goldman Sachs, and before that she ran the international analytics desk at Bear Stearns in London. Nomi, welcome to the Keiser Report.
Thank you.
Nomi Prinz, this is a story that's breaking. Emails show that Bear Stearns traders telling their superiors they were selling investors like Ambac, quote, a sack of Your thoughts?
Yeah, that's pretty much what was going on. As we all found out when the financial crisis reached everybody's ears in late 2008. Of course, this was going on through late 2007 and early 2008. Ambac was one of the investors in also something called a wrapper. They basically looked at the toxic assets that Bear Stearns created out of crappy loans, out of defaulting loans, out of things that were cheap for them to buy off of banks and stuff into toxic assets. But they failed to tell Ambac, who was wrapping these assets, or the rating agencies, how crappy the loans they were stuffing into these assets really were. This wasn't just Bear Stearns doing this, of course. This was every bank that was creating assets doing this when they could, however they could. But of course, the lawsuit is coming out now. The information behind it is coming out now. JP Chase now owns Bear Stearns. It received Bear Stearns with our money, with our federal backing to the tune of $29 billion during the spring of 2008, which was around the same time that Ambac opened its lawsuit against Bear Stearns. So we are still looking at that fallout.
All right, now let's look at this suit filed by Ambac against J.P. Morgan. It states, quote, knowing that its fraudulent and breaching conduct was resulting and would result in grave harm to Ambac, Bear Stearns then implemented a trading strategy to profit from Ambac's potential demise by shorting banks with large exposure to Ambac-insured securities. Isn't that against the law?
Unfortunately, it's in that gray area where the law doesn't really keep up with what's going on at these investment banks, and it still doesn't. What happened then was very similar to what happened with the Goldman Sachs case and shorting loans that were going into their Abacus deal, for which they then settled with the SEC for $550 million, admitting no wrongdoing. The same sort of thing, in a little bit of a different set of details, is really at play in this situation. Bear Stearns basically sold or shorted Ambac because they knew that Ambac was wrapping crappy deals. So Bear Stearns was getting in there and figuring out, you know, we're giving them crappy deals. This is not going to work out well for Ambac. We're going to short it. There's no legal problem with that. It's a moral problem. It's a gray line. It should be illegal because you're effectively misleading your wrapper. You're not giving them time to figure out what assets you're stuffing into what they're wrapping, what they're investing in. And at the same time, you're basically playing that they will blow up, which effectively is what both Ambac and Bear Stearns did.
Yeah, but if I buy life insurance on somebody and then I kill them to collect the money, or I buy a home insurance on a house and then burn it down to the ground and collect the money, isn't that illegal? It's the same. It's the exact same thing. Why isn't that legally the exact same thing?
That obviously that is absolutely illegal, and the reason it's not exactly the same thing is because our regulatory system is so very, very flawed that what's going to happen now is JP Morgan's going to come out and say, you know what, we'll settle this. We didn't really do anything wrong. Bear Stearns we weren't really a part of them. They didn't really do anything wrong. They were just making trading positions that so happened to have been against the insurer, the investor in the crappy deals that they were putting together. It should be illegal. And I could argue that it actually is illegal because you are falsifying information in order to profit on the other side. The SEC so far hasn't found this to be illegal in other situations, whereby lies the problem. It should be. It certainly is if you kill someone that you've taken life insurance out of. And effectively by shorting Ambec, they were killing Ambec's rating before Ambec even went bankrupt, because that was basically, by shorting Ambec, they were decreasing the value of its stock. They were decreasing the value of Ambec's capital. They were helping to force it into bankruptcy while they were shoving their loans and their into toxic assets that Ambec was wrapping. So the whole thing is completely shady, should be illegal. The question is whether the SEC can figure it out this time or any time to actually declare it as being illegal.
But it's also an instance of insider trading. And insider trading is clearly illegal. But I want to move on to something else because you've been writing about it, talking about a fraud-esque like moment that's happening in the present. And this is the Goldman Sachs Facebook deal. Why is it worse than the crappy CDOs that Goldman was admittedly selling, referring back to what we were just talking about? Fill us in on this latest scandal.
All of this is a spin on the investment bank knowing more than what it is letting on to the investors and trading on the back of that, or being able to trade on the back of it, and so therefore being able to profit on the back of withholding information. And to a large extent, the Facebook deal was like that. It's a private deal, so it doesn't fully fall under the same public purview and rules as insider trading per se. But what Goldman basically did was raise a lot of capital, and they just went offshore to raise this capital because of the scrutiny that was put on this deal in the United States. I like to think also by some of the articles I and others were writing. And they didn't want to be bothered, and so they went and they raised money for this Facebook deal offshore. And the reason it's shady in that respect is because Facebook, in the course of this deal, and yes, it is private, has not really disclosed the information as to how it ticks financially. Facebook will not disclose this information until 2012. So basically 14 months after investors have succumbed into going into this deal and have worked with Goldman to raise capital to basically allow Facebook to be valued at $50 billion as opposed to the $10 billion that it was valued at just a year ago. And the way Goldman has kind of structured the deal is they put in some seed money, which is how CDOs work. CDOs always worked on the basis of the investment bank would put in some money, some hedge fund would put in some money, and that would entice other investors to follow along. You know, there was a cushion there. Someone was giving it a stamp of approval, which is sort of what's happening with this Facebook deal. Now, it's very possible that Facebook is the be-all, end-all in 2012 and 2013, when Goldman's investors are actually allowed to get out of the deal. Goldman, of course, can get out of the deal at any time, as they could with the CDO. But, you know, it's also likely or possible that that won't be the case. And the investors in this deal are paying 10% to Goldman in the case it even occurs that their value goes up in this deal when they can get out, and fees to Goldman in order to structure this deal and allow them to be involved in it in the first place. And I think the fact that they went offshore and they had to get outside investors from the United States is very telling.
Yeah, but wait a second here, because the law is that to get more than 500 investors, you need some additional disclosure. What Goldman Sachs did was they decided to invent a new concept, which was that they took one of those shares or one of those holders and they split it into a holding, which would allow others to participate. And that's an idea that they should have gotten the SEC's opinion on before they went to the market and breached what is the standing legal statute. They breached the law. I mean, that's not the way the law reads. So why can't they get an SEC opinion first? Why is it always on Wall Street? They break the law first, and then they say, well, we're going to go ahead anyway, and it's up to you to change the law. They're always wanting people to change the law. What about obeying the law?
Absolutely, but the thing is, it works for them. In this particular situation, they basically said to the SEC, we're going to create this offshore vehicle. We're going to have investors in it. We're going to call them 499 when they could be like, you know, 20,000. We don't know. They're basically investors piled into investors. And we're going to basically do that. Oh, and by the way, if we want, we can get out, we can short it, we can do whatever we want. We're just letting you know. And the SEC is generally so far behind anything that happens that it has yet to even state an opinion. Facebook had to come out and say, you know what, we get this is a little bit weird, so we'll tell you what, in 2012, in April in 2012, if we still have this many investors in our deal, we'll either go public or we'll decide to disclose this information, which we should be disclosing anyway, because technically there are more than 500 humans who are invested in this deal. But that's not the case because the SEC is really, really behind things. Goldman stated it. Goldman then decided, hey, you know what? This is going to get a little bit dicey, so we're just not even going to deal with the SEC right now. We're going to do this outside of the country, and whatever happens later will happen. And you know, one of the things is some of the investors that Goldman even went up to ask for money in the United States, for example, Jim Clark, who was the former Netscape founder, was just, you know, like there's no way he would partake in this deal, not actually, he didn't say because of any potential illegality, but, you know, just because of the fact that it was overvalued and overfeed. You know, hello, that's how these deals work. The SEC is yet again behind the laws it actually is supposed to enforce. Again. Right.
Jim Clark's comment was that Goldman Sachs is putting their interest ahead of their client's interest, which again breaks the law, which is about fiduciary responsibility. Securities Act of 33 and 34 are quite clear on these points, and they routinely break the law. And the only reason why they're allowed to do so is because the regulatory agency covering this particular aspect of law in America is understaffed. So Goldman Sachs, instead of maybe doing something that would help the overall economy of America, instead of destroying it, decides, well, this is our opportunity to make some more coin for us by simply abusing the fact that there is no legal entity covering us at this time. Now, of course, this comes on the back of Goldman Sachs becoming a bank holding company as part of the massive bailout, which again, that doesn't make any sense, does it? Walk through that transition that went down at Goldman Sachs and why this makes this even more problematic, if you could, Nomi.
This is coming down to something that the Federal Reserve did to us. And by the way, this also relates to what we're talking about with J.P. Morgan and Bear Stearns. The Federal Reserve decided, hey, you know what, J.P. Morgan, take Bear Stearns, we'll back whatever it is they did with money that we'll print and are still backing. And the same thing in a different vein happened with Goldman Sachs and Morgan Stanley back in September of 2008, which is these firms did not have enough capital to survive the weekend. And so on a Sunday night, they basically got to the Fed and said, you know what, we need capital. That might have not been the exact conversation, but that's why banks go to the Fed when they are in dire straits, because they need capital. But the problem was Goldman Sachs and Morgan Stanley were not classified as bank holding companies, so technically this was a situation, again, where you push the law, but then the law changes for you. And in the case of the Fed, it didn't really have to change that much. The Fed just said, okay, fine, we're going to waive our 5-day antitrust, check it out period, which we obviously did with J.P. Morgan and Bear Stearns. We're going to just keep on doing whatever we can to help you, and we'll just call you bank holding companies now. And as a result, you'll be able to access our money, our capital from us at very cheap levels. You'll be able to use the fact that the Federal Reserve backing you means that you can also now go out into the market when the market's better and get investors to give you money again because the Fed is backing you. And all of these things that are beneficial to a bank holding company because the Fed and the government back you. Even though Goldman and Morgan Stanley were not actually acting like the classic, what should be considered a bank holding company, which is a bank that holds deposits and loans for people.
One last question. The Federal Reserve Bank recently has said that we're going to change the way we do accounting. So all this garbage on our balance sheet, we're never going to have to pay for it. We're just going to we're going to keep it for an infinite period of time because we've totally changed the way the whole concept of accounting works. If you saw the story, can you comment on that story?
Well, it's very much what the Fed allowed to happen to the financial industry after the bailout, which is basically to change all their rules so they wouldn't have to value securities at market levels because there was no market. The Fed knows and has known that the stuff it has on its balance sheet has no value. Or has very limited value. I continue to say it has no value, but it has limited value, and particularly if the Fed were to decide to sell it back into the market. The reason that is not happening is because it can't. The market doesn't want it. And so what the Fed is going to do is basically defer evaluating this stuff until it matures or something of that nature, so that it doesn't have to show how risky, how badly positioned the Federal Reserve is, having dealt with the financial crisis. And it can continue to pervade this myth that the Fed did everything it did right and everything it had to do, and we're actually in a much better state because of that. That's really what's behind the accounting changes at the Fed.
All right, Nomi Prinz, thanks again for being on the Keiser Report.
Thank you.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Nomi Prinz. Her book is now out in paperback, and you can find out more information at her website, nomiprinz.com, NOMIPRINS.com. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.